Hey, this is Skyler with Regan Capital. Today we're going to talk about mortgage bonds and what's cheap and what's rich in our opinion right now. Today, if we look at this screen, it's a really good day to be talking about this because the ag finally has broken even for the year after a long period of being in the red with last week's rally on rates. We're at plus 0.09 for the percent on the ag. And if we look down here, we get to the MBS ag. So these are all Bloomberg ags. Let's click on that. And what we're going to see here is an overall universe of securities. These are all government guaranteed agency bonds, about 1,000 members, about $8 trillion. And what we're looking at, first of all, over here is the weightings. Okay, so this is a market weighted index. So the largest issuances in the index are going to be the most heavily represented. So we see here Fannie 2s of 2021 over a 7% weight. Down here, we can look at metrics of spread, duration, price, coupon, maturity. Okay, so why are Fannie 2 and 2.5s the largest weightings within this index? Okay, so if we go over and we look at the agency universe as a whole, we're just looking at Fannie Mae here. Fannie 2s and 2.5s had roughly $3.5 trillion in issuance, with about $2.5 trillion outstanding. So this really is a market-weighted index. So if you're out there investing in an ETF or a mutual fund that's mimicking the agency Bloomberg index, what you're getting are these really low coupon paying bonds. Okay, let's take a look at the curve quick. Updated as of today, you have a very inverted curve where on the short end you're getting 540, on the longer end you're getting about 430, and this is going to be useful when we get to analyzing some of these bonds. If we look at current mortgage spreads, and this is one of the reasons why folks will say, oh, mortgages are really, really cheap right now, because in general they are. This is the spread of the current coupon mortgage bond over U.S. Treasuries. What is current coupon? What does that mean? It means bonds that are basically issued today that trade closest to par. The current coupon being really in between Fannie 5.5s and 6s. Let's call it Fannie 5 3/4 is your current coupon bond. And that spread over 5 to 10-year Treasuries. So it's the current coupon spread over a mixture of 5 to 10-year Treasuries, because generally these are 6-7-year bonds, is currently at about 145 basis points. And we go back 5 years here, these peaked during COVID at 188. But post-COVID, these were sitting at 80 to 100. We go back a little bit further. Normal post-GFC is probably in the 100 range. Pre-GFC was probably in the 120 range, and today we're at 145. So generally speaking, agency mortgages are cheap, okay? But don't let that obfuscate, or don't put all mortgages into that box of being cheap. Okay, so we looked at agencies. You have $3.5 trillion of issuance, $2.5 trillion of Fannie 2 and 2.5s. If you go down to 6s, it's only about $250 billion. Okay, Fannie 5.5s, 6s add up to about $500 billion. So let's look at that index bond, Fannie 2.5s. So Fannie 2.5s are paying about a 330 coupon. That's what the underlying mortgages are paying. These loans are on average about 3 years old, 39 months old. The bond itself is paying $250. And its current dollar price is $82. Okay. So when this was originated, these borrowers were thought to prepay at a very, very fast rate, 25 to 30% per year, 25 to 30 constant prepayment rate. Today, they're paying about 5. Okay. So this went from a 2-year bond to roughly a 7-year bond. And your current spread on this bond is about 80 for a yield of about 5.07. But that doesn't marry up very well versus the current coupon spread of 145. Let's go look at a Fannie 6. So this bond's 2 months old. Underlying borrowers are paying about a 7% coupon. And these are estimated to pay off at about 18 CPR. And so what's unique about these is because of that high coupon and because they're new, you really don't know if they're going to pay 40 CPR or 10 CPR. Okay. So that's really one of the issues on owning this piece of paper is it's modeled to be a 4-year bond, but it could be a 2-year bond or it could be a 5-year bond. Or what we saw on those Fannie 2 and 2.5s, they could end up being a 7-year bond. Okay. So, what you get here across the board is a much higher yield than those 2.5s. But because you own it at par or a little bit over par, you don't know if there's going to be downside from there. If prepayments go up precipitously, you might lose some yield. If they decrease, you're going to gain a little bit of yield, but you're going to extend out. But this is where that high yield or high spread comes from, is because of that variability, because these are so new, you're going to get a much higher spread, a much higher yield. So buyer beware when you're looking to invest in agency mortgage bonds. Those index funds may not be the best solution. Okay. Further to that, if we look at the current curve, there's a solution out there, which is floaters. Okay. Agency floaters allow you to invest at the front end of the rate curve, i.e. 540, plus an extra 80 to 120 basis points. So you can get a 6.25% to 6.5% yield on a floating rate bond that has almost no rate exposure. Whereas when you go buy this fixed rate bond, let's call it a 4.5 here, you're buying off of this part of the curve, one of the lowest nodes on the curve. So you're only getting a 585 yield or thereabouts. Thanks for your time.